Good afternoon. What's up, everyone? Hope your day is going great today. Tomas Patterson here with Boss Financial with another video. This is my 6th video now. We've been going steady, but throughout all the content I've posted, we've talked about things like stocks, investing, and even some strategies, stuff like that. But this is all assuming that everyone actually has some experience or is knowledgeable about the stock market. For those of you who have been watching my videos, following along, maybe learning some things, but you have maybe no idea what the stock market is or how it operates or even where to get started, this video is for you. Personally, I think the stock market is one of the best, if not the best, place to put your market if you are diligent and you're patient and you want to gain a lot of wealth. There are many options to gaining wealth, but I'm going to go over and explain why the stock market is so special and things you need to consider if you want to dive in and start owning stocks today. So I'm going to try and be concise here, so let's jump right into it. So first, what's important that we go over, since this is a basic crash course, we're jumping into the stock market, but what in the mother of pearl is a stock? To own a stock means you have shares in or stock in a company. What does this actually mean though? No, we're not talking about stock like when Timmy's runs out of your favorite donut, okay? What a stock or shares translate to is a piece of ownership in a company, okay? Or equity in a company. Have you all seen those shows Shark Tank before? Or Dragon's Den? When they're giving up equity to these venture capitalists, okay, they're giving up a percentage or a piece of their business in exchange for this money. This is similar to companies giving out stock, okay? When you buy one share in a company, that makes you a shareholder, which is an owner of the company, even if it's at a very, very, very small percentage. Being a shareholder gives you certain rights, like the right to attend annual meetings for shareholders, as well as the right to vote. You can be an individual, a business, even an institution to buy stocks, but when you're doing this, you're hoping that the value of stock is going to increase over time as the business grows and expands and increases its revenues and profits. But that doesn't mean you're just gambling, getting in and out of positions quick. Like we covered in my last video, the difference between a trader and investor, the stock market's best used with the strategy of long-term investing. Now, of course, there are a lot of great options to get a great profit in the short term and the medium term. You could get in and out of a position at a good time. You could do a few swing trades over a series of days, weeks, even months. But it's important to remember when you're getting this increased potential for reward, you're also giving yourself more risk than you might be able to handle. The best way to get comfortable is to play it safe. When you make a smart investment, your money's going to be safer, and then you're going to feel more inclined to be interested and optimistic about the market. I couldn't even count on one hand the amount of people who jump into the market, whether it's with just a little bit of money to test out the waters, or even they bring in a big chunk of money that they saved up over time just because they feel like they need so much to get started. Next thing you know, they have no idea what they're doing. They know nothing about the companies they're buying, because remember, when you're buying shares in a company, you're buying equity, all right? So they just end up losing all their money because they clearly didn't care enough about it in the first place, and they leave with a sour taste in their mouth. So if you're picking good companies, smart investments, and holding for a long period of time, we're talking a series of years, even decades, then you're really going to have little to worry about. Notice I didn't say you're going to have nothing to worry about, just very little. One thing I can promise is that over time, the markets have done nothing but increase. The Dow Jones Index, the S&P 500 Index, these are both good general gauges for seeing the performance of the stock market. They've had a steady increase over time. So if you put your money there and you leave it there and you continue to invest, then your money is going to compound over time, and it's really going to work for you, and it could be surprising how much. Now, don't get too sweaty over there with excitement, okay? This doesn't mean that you could just continue to profit forever, okay, by just leaving your money in there. Like we've talked about before, no single person can predict the market, where it's going to go. It's just that on average, it increases over time. For example, in 2008, we had the financial crisis, okay, and that led to the Great Recession, which was actually the worst crisis we've had since the Great Depression, okay, in the 1930s. So obviously, the markets were really low then. If you were to sold everything after it started dropping, then you would have lost a lot of money, like a lot of money. But then consider 2017, for example. We were on a major bull run in the market, just a huge spike. Bulls are optimistic, okay? Being bullish means that someone has intentions of the company's value increasing over time, okay? So they want to buy in. They feel that the price is worth it currently. Bears, on the other hand, they're pessimistic. So if you're bearish on a stock, it means that you have a negative outlook on the company, meaning you think that the stock price is going to decrease over time, so you want to sell your shares. You want to get out of there. If you're a bear and you have no shares, then that means you have no intention of buying, and you might even look into shorting shares, which is something I'll get into later. So in this bull run in 2017, it was actually almost impossible to lose money, okay? I think the total return of the market was like 25%. So then come along 2018, things were doing great. We were off to a booming start, but then the market collapsed, okay? And this was actually the worst the market performed since the 2008 financial crisis we just talked about. So a lot of gains were erased at the end of the year. So as you could tell, the market goes up, it goes down, but on average over time it's going to increase, okay? Over the past 30 years, the S&P 500 has averaged about 6 to 7%, and since its inception in 1929, it's averaged about 10% a year. So I always want to stress, if you're owning stocks, then I recommend that you consider this money locked up at all costs, okay? Especially if you have the tendency to want to panic sell every time you see red, or if your stomach just twists, okay, every day that you're sitting at a loss, just consider this money locked up. If you're in it for the long run to maximize gains over time, okay, then don't even worry about the price of the stock. It doesn't matter at all. Just picture them how they are, and that's pieces of ownership of a business. Ride the ups, ride the downs. As long as you're picking a good business, you're going to be successful, okay? That's a business with good financial statements, your balance sheet, your income statement, and that's increasing in profits over time. It's best to invest in companies with a wide moat, okay? That's a good competitive advantage that's going to keep competitors at bay, keep the company safe for years to come, because this reduces your risk. So while it's possible to catch a big fish, even a whale at some times, okay, don't think that this is just going to be a permanent, continuous thing. Don't get into the market if you want to be an investor and then think you're just going to hit it big on penny stocks, okay? It's not going to work. Consider investments more of seeds that you're planting around to grow over time, because good things take time. It's the long-term perspective that's what's important. You just got to make it a lifestyle to grow your portfolio properly and, just not be ready to jump ship every time something goes south. When it comes to stocks, there are generally two types of stocks you can buy, okay? These are either dividend stocks or growth stocks. Dividend stocks are shares of a company that, pay dividends. Dividends are monetary payments made out to shareholders every year, and the payments can be annual, quarterly, that's the most common, but they can also be semi-annually and monthly. Dividends are essentially profits from the company that are passed down to shareholders to thank you for investing, as well as to incentivize future shareholders to buy stock. The dollar amount you receive from dividends is regarded to as the yield, okay, which is the percentage of that stock's price that the dividend accounts for. So say if you bought a $100 share of a company and that company paid out $1.50 dividend per year, then your dividend yield is going to be 1.5%. Okay, but hear me when I say this, it's important not to go out chasing stocks that just have a high dividend yield, okay? This is a common mistake for beginners. A high yield can often be alluring for an uninformed investor, but trust me, behind that pretty face, okay, is an absolute disaster at times, a black hole, if you will, for your money. A lot of times companies that pay a high dividend yield are considered risky, okay, because the higher dividend yield that companies are paying out annually to shareholders in dividends, the less money there is left over to put back into the company to help them expand and to grow. So this is a little subjective, but I would say that a safe dividend is probably anywhere from around 1 to 7, maybe 8%. Anything over that, you're probably really starting to increase your risk. Remember, dividends aren't guaranteed. There's no requirement, there's no obligation for a company to continue paying these dividends, so at any time these could be cut and leave you without that income. A higher yield could also reflect a recent stock price drop, which could signal that a dividend cut is looming shortly down the road. A lot of companies pay a high dividend, say 10 to maybe 18%, and this looks good in terms of potential, but trust me guys, most of them are just ticking time bombs. On paper, they could be paying way too much of their net income out in dividends, which leaves them with nothing or very little to put back into the business and to expand. Hey, I've even seen companies that, they boast a high dividend yield, but then if you go and you look at their balance sheet, every year they're going further and further into debt just to pay out these dividends. It's not a good thing at all. And let me tell you, if you're investing in these types of companies, your day is going to come, okay? That's not a threat, that's a promise. Instead, focus on companies that have a good balance sheet, they have a good moat with little competitive threat, and that don't pay out too much of their cash in dividends every year. It's also good to look for companies that are increasing their dividends over time, okay? Because then you benefit from this appreciation as well. If a company has not missed a dividend and they have a history of increasing their dividends year over year for a consecutive 25 years, then these companies are considered dividend aristocrats. And there's an annual list of these printed out. You could Google them yourself. Okay, now on the other end of the spectrum, we have growth stocks. Growth stocks, unlike dividend stocks, do not pay a dividend. They use this money they could be paying out in dividends every year and instead choose to reinvest that money back into the company to help it grow. This helps the company to expand, and generally they're going to have higher returns as they're putting money back into this company to grow, and you're going to benefit from these shares appreciating in price, and you're going to profit when you sell them. So dividend stocks are more for a cash flow type investor or someone who wants a little extra incentive to invest in a company of their choice, and these work best with the long term, the buy and hold strategy. This allows you to benefit from the compounding of the dividends and rebuying shares, as well as the appreciation in stock price over time. While growth stocks, on the other hand, have no dividends to compound, and you're generally going to sell these once you've hit a return down the line that you're comfortable with. This isn't always the case, but a lot of the time. Now, besides these two types of stocks, it's also completely possible for a company to be kind of both, okay? A growth stock that also pays dividends. We could consider Coca-Cola a good dividend stock, okay? They've paid dividends for years. They have a lot of cash on hand, a good moat, and a relatively stable stock price. Amazon, on the other hand, okay, we can count that as a growth stock because they pay no annual dividends. They reinvest all their profits, and that's led to a very drastic increase in stock price over time. But when we look at, say, Microsoft, for example, okay, it's easy to see both. Microsoft is one of my personal favorite companies, okay? At the time of this video, they're actually the most valuable publicly traded company out there, and they are clearly a growth stock. You can see how this share price is just taken off over the years, but on top of this, they also pay like a 1 to 2% dividend on top of that. Although relatively small, this dividend can do a lot of work for you, especially if you keep repurchasing shares and you're in it for the long haul. Microsoft is even eligible for a DRIP, okay? That's DRIP, and this stands for a Dividend Reinvestment Plan. This plan is offered directly by the company and not by your trading platform. What a DRIP does is every time you're entitled to dividends, instead of receiving these as cash payments, you're going to be entitled to extra shares or even fractional shares. This builds up over time and allows for the maximum compounding because you're getting these shares from the company itself, which a lot of times you could get them at a cheaper price than the stock market, and you're also not dealing with trading fees, which eat into your return. If you really, really want to load up on a company, this might actually be your best option if you're in it with a long-term perspective. Keep in mind though, even though you're not physically receiving these dividends as cash, you still need to claim them on your taxes as income. Now, if we're going to talk about loading up on one company, okay, there's one concept I really want to talk about, and that concept is smashing the like button. No, I'm just kidding, but do that if you haven't already. But the concept I do want to talk about, okay, that's diversification. This is a huge one, guys, okay? Do you remember that old saying, don't put all your eggs in one basket? Well, this is based on the same principle, okay, guys? Think about it. If you put all your eggs in one basket, what happens if your basket breaks? What happens if you drop your basket? What happens if you trip, snap your ankle and land on top of said basket, okay? It's not good. Why? Because chances are all your eggs are going to be smashed. The same idea goes with investing, guys, okay? Even if something looks rock solid, there's always something in the market, and that's called risk. You might think that you're an owner of one of the best companies in the world, okay? But who's to say that 10 years from now, 20 years from now, the company's going to be that good, okay? Who's to say that the company's going to still be here at all? Maybe a competitor would have crushed them, okay? Maybe they would have lost all their money, went bankrupt, or maybe even a lawsuit, something like that, ruined them. The list really goes on. This is why it's important to diversify your holdings. If you're someone who really likes picking favorites, then it's simple. You just need to pick more favorites. I would try to get at least 10 to 20 different stocks throughout your investing career, and if you're focused on dividends, then this could potentially be a lot higher. Now, it goes without saying it's absolutely possible to over-diversify, okay? This means that you have too many holdings, and the ones that are doing bad are actually taking away from all your companies where you're getting good returns on. So this will result in you really not getting much in return, and that's why it's extremely important that you understand the companies you're investing in. You're doing your due diligence, your research, because this reduces your risk when you know you're investing in a good company. This also isn't just tied to companies, okay, but industries as well. Investing in different industries such as health, tech, consumer goods, utilities, stuff like that really helps you overcome shocks to a particular industry. For example, let's say you held all your eggs in one basket, okay? You only owned a steel company. Say that steel industry is now hit with something like tariffs or high taxes, then you could potentially take a real dive in your portfolio and end up losing a lot of money. This even goes for people who are buying cryptocurrency, okay? A lot of people I see who are starting out investing, stuff like that, they jump right into stuff like Bitcoin. They pile all their money there instead of sprinkling it into the stock market as well. Now, I'm not going to get into all the different sides of that. I'll leave that for another video regarding cryptocurrency, Bitcoin, stuff like that. But now let's say you wake up one morning and no one wants Bitcoin. We start to doubt the value of it. there's any tangible value at all, and the price plummets to zero. Now, because you didn't diversify, you held all your money in Bitcoin, you're out all that money. So in short, you want to buy a variety of companies, but also have a variety of industries that are uncorrelated, okay? So Microsoft, that's uncorrelated to McDonald's, okay? Pepsi, that's uncorrelated to Nvidia. And most importantly, you want to make sure you're buying good companies. An easy way to diversify these days, okay, for people who want to get less involved, they don't want to invest too much of their time into it and pick their own stocks, are ETFs and indexes, okay? ETF stands for exchange traded funds. These hold a basket of stocks from uncorrelated, even correlated industries. And with ETFs, the sky really is the limit, okay? You could probably find an ETF for anything specific you're looking for. Whether you want a fund that matches the stock market as a whole, okay, so you're getting complete exposure, total diversification, and you're getting a return year over year that matches the stock market, just pretty much like a set it and forget it. Or maybe you want an ETF that focuses on just dividend stocks, or maybe Canadian mid-cap stocks. Or maybe you might want something like a marijuana ETF, okay? If you want to dabble in all that excitement as the legalization spreads, you get access to the whole weed market with just one fund. These are just as easy to buy as stocks are. They each have their own ticker symbol and you buy units of them. ETFs are looking like a better investment option compared to things like a mutual fund, for example, because the management expense is significantly less and it just seems to be getting cheaper and cheaper as the years go on. So when it comes to investing in the stock market, some of the most important advice I could give you is to start now. Everyone always seems to want to hesitate, or they get scared off thinking that they can't be successful in the stock market. You don't need $10,000. You don't need $1,000. I think I started investing with like $150, $200, okay? To start your journey, the most important thing you can do is to just start putting money in your account, okay? Even if you're not going to start buying shares until you accumulate, a bigger amount of money, at least you're bringing your horses to the gates. What comes with starting early is the knowledge and wisdom you're going to get with this experience, and this experience is going to help to compound your wealth down the line. The longer you're in the market, okay, it's very simple. The more you're going to learn, okay, and the more you're going to get to understand the market. And let me tell you, this knowledge does not come from sitting on the sidelines. No amount of textbooks or YouTube videos, okay, is going to get you more prepared or more experienced than you are yourself by just starting. The best time to plant that money tree was yesterday, okay? So you need to start researching trading platforms and see what works best for you. You need to factor in things like simplicity, usability, customer service, data research, as well as things like trading fees. Trading fees are something that a lot of people neglect to think about, and it actually eats into your returns pretty heavily over time, okay? Especially if you're making a lot like frequent trades. Some trading platforms kind of do it like the math you do in finance, where they'll charge a commission probably 1% to 2%, something like that of the trade. But these days, most I've seen, they just charge a fixed rate, and that's generally $5 to $10 per trade. So you need to consider this trading fee part of your money invested, okay? Because you're going to pay it A, when you buy, and B, also when you sell. So say you bought $100 worth of stocks and then you sold for $150, okay? Let's say you're paying a trading fee $7. So that means you had an extra expense of $14, which means in the end, you netted $36 instead of $50. This is why you need to focus on making larger trades, okay? Meaning that this trading fee isn't eating into too much of your returns, and it's a smaller percent of your total amount invested. And less frequent trades, meaning that you're going to wait until you have a decent amount of cash in your portfolio that's going to make your trades actually worth it. This all comes back to an earlier video I posted where I talked about, dividends and reinvesting. Instead of investing the little money you have each time as the compounding starts off slowly, wait until you get a bit more money, okay? A bunch of money as time passes, as well as you're adding in more of your own money. Making these larger and less frequent trades is going to leave you with a lot more money in your pockets over time, guys. Believe me when I say that. Another tip related to achieving a solid return over time, okay, is to always be constantly buying shares. This is called dollar cost averaging, and if you're planning on continuing to grow your portfolio and you're in it from a long-term perspective, this is a really smart strategy. So many people try to time the market, okay? This is where the majority of people are going to fail, and they're going to end up going home, walking away with their tail in between their legs. Instead of trying to find the right time to buy low, sell high, you should just always be buying shares. Don't sell. Now, I'm not saying, okay, go out and buy at an all-time high. You could still potentially wait for a little dip, a little correction, but in the end, who's to say that there's going to be this dip, at least in the short term, and the price could just continue to rise. When you dollar cost average, it's pretty much just as the phrase describes, okay? You're buying at the highs, you're buying at the lows, you're buying at the mids, consistently, and over time you're just paying the average price of the stock. This reduces the volatility on your large stock prices, and it's the best way to reduce your risk from market fluctuations. Typically, you want to invest the same amount of money on a regular basis. For example, if you just happen to buy $1,000 worth of stock at the most inopportune time, okay, then the stock price decreases, well, you're going to be out a lot of money, okay, and the average cost of your shares is going to be way higher than the current price of the stock. The way to combat this is to, well, you guessed it, buy more shares. Now, I'm not saying buy into something like a falling knife where the price is just going to continue to keep plummeting and you're buying into that and just losing more and more money. Remember, we've talked about this whole time of making smart investment decisions. When you buy more of these shares at the lower price, okay, assuming that you bought enough, this is going to decrease the cost per share that you're paying, and this is called averaging down. Over time, as the share price hopefully increases with the price of the market, you're going to have an increase in the value of your holdings there, as well as you're going to cover yourself from all of the bad moments that you bought shares at. So guys, an easy step number 1, open your brokerage account. Choose who you're going to go with. I personally invest with Qtrade. I'll drop another link in the description below, but there's also things like Questrade, Robinhood in the States, which is a no commission trading platform. And then a lot of people choose to invest through their banks. So things like TD, CIBC investing, it all comes down to personal preference. When you make your trading account, you're going to have to choose the types of accounts you're going to put your investments in, okay? This can be a Canadian account, a US account, but there's also things like a TFSA and an RRSP you can put your holdings into. So if you're curious as to what those are, I have a video titled TFSA versus RRSP. I go over them there. They're just really crucial to growing your wealth over time, as well as reducing the taxes paid by you. You also have the option to open a margin account, okay, which will allow you to short stocks. Shorting is where you buy stocks with leverage, okay, meaning you're borrowing shares that you don't own from your broker, and you're going to sell these at a high price, and then you're going to buy these shares again at a lower price. Give these shares back to your broker, and you keep the profit. This works if you're anticipating the stock price to drop, okay? So it's essentially the opposite of the buy low, sell high. In this case, you're selling high and then you're buying low. Remember that stocks are a zero-sum game, okay, guys? There's always a winner and a loser in every transaction. Me personally, I don't recommend you get into margin trading, shorting stocks, because number one, there might not be enough stocks available. You're not buying shares directly from the company, okay? You're getting them from the brokerage. So this is assuming that the brokerage has enough, if any at all, to lend you. And then it's also common to just not be able to short certain stocks at all. Next, you're charged interest on the shares that you borrow. Obviously, the brokerage wants to make money, so borrowing these shares from them, it's not going to be free, okay? And this really eats into your returns as well. And most importantly, guys, another reason why I don't really recommend getting into margin trading, shorting, is because you need to have more and more money in your account as collateral. So what do I mean by this? Well, simply, since you're borrowing these shares to sell at a higher price, and you're then hoping that the price is going to decrease, what happens if the share price just doesn't decrease? Stocks can, in theory, increase indefinitely, just keep going up and up. So in theory, you could be out an infinite amount of money. Now, obviously, this isn't literal, okay? No stock's really going to continue to just increase indefinitely, but you get what I'm saying. So if this price doesn't fall and it continues to increase, then your brokerage is going to give you a margin call, okay? What this is they're going to demand that you put more money into your account, or they're just going to cover the short for you. So in my opinion, especially if you're just getting started in the stock market, this probably isn't the best option for you, and you could potentially, lose a lot of money and ruin your investing experience. The two main reasons for shorts are to A, speculate, okay? You're anticipating the stock price to decrease in the future, hopefully due to your own research, okay? And then B, to hedge, meaning you'd like to protect a long position with an offsetting short position. Number two, guys, start putting money in. Start depositing money into your trading account. You could do this by an electronic funds transfer that takes it out of your bank. This generally takes about 2 days. Or you could do things like adding your trading platform as a bill payment vendor on your banking, and that usually they can get it the next day. Or if you can't do these things, I'm assuming most places these days will still accept a check by mail. If you're having a hard time finding disposable income to invest with, chances are you still have room in your budget somewhere. So you need to sit down and track your expenses and figure out where you're spending money every month and try to cut these things down. Try to pay yourself first, like I've talked about in other videos. That is, every paycheck, you're going to take a set percent, say 10 to 20%, and put this into your trading account. Pay yourself first before you pay your bills, before you get your gas, before you go on that shopping spree in the mall, okay? And you'll just end up thanking yourself a million times over in the future. Paying yourself first really sets you up for some major wealth. Keep continuously putting this money into your portfolio to help it grow. Keep funneling it in and get that money compounding. Try not to make too frequent trades or trades of too little value. Number three, make sure you know what to look for in a stock, okay? And to do your research. Research can make or break an investment, and you always want to make sure you're doing the best job you can to help reduce your risk and just know what you're investing in. Get comfortable looking at financial statements, okay? So your balance sheet, your income statement. Get to know important ratios like your PE ratio, which is price to earnings ratio, your EPS, earning per share, stuff like that. And it really helps you understand what kind of company you're investing in, what kind of company it is behind closed doors. And lastly, number 4, split your money up. That means diversify. Like we spoke about before, you want to invest in different stocks, industries, as well as different risks, okay? So stocks, bonds, and indexes, ETFs if you want. All assets and securities come with their different risks as well as different rewards. The ones that tend to yield the highest returns, okay, are also most likely the most risky, and it goes without saying the ones that are more safer to invest in are generally going to yield a lower return on your money. It's important to figure out your risk tolerance as an investor, as well as to pick a strategy and to stick to it. And number 5 is, okay, no, I'm just kidding. There is no number 5, but in place of step number 5, I just want to reiterate, keep putting that money in there. Load that account up, load that portfolio up, continue to do so. And whenever you have the money to invest it. It's really simple. So that brings me to the end of today's video, the stock market crash course for beginners. Hopefully I was able to give you everything you need to get started, answer all your questions at a basic level, and maybe inspire you to make the call or make those couple clicks and get started with investing in the stock market today. It's doing what most people aren't doing. That's really going to get you ahead of the game, and it's going to allow you to maximize your wealth by putting this money to work over time and compounding it. If you enjoyed this video, smash that like button. If you learned something, share the love. Subscribe to my channel if you like my content and want to help my channel grow. I appreciate it very much. Share with a friend or a family member who could really use some financial education, because guys, that in the end, that's all I'm really here for, okay? To give you guys information. I want to give you inspiration and really just a new perspective to help with your financial journey. Follow me on Instagram at Boss Financial Channel. I haven't really been too active there yet, but I plan on doing some postings soon. It's just another way to get social on another platform. So yeah, with that everyone, thanks for watching, stay positive, and see you next time.